we're not talking annual or biannual. No, we're not even talking quarterly or monthly, but we're talking weekly dividends with the brand spanking new SoFi Weekly Dividend ETF. Let's get to it. Hey, you found me. What's up? I'm Russ. This is Dapper Dividends. Thank you for swinging on by the channel and investing a little bit of your time with me. Yeah, we are talking a brand new weekly dividend ETF from the fine folks at SoFi who brought you such hits as the TGIF bond ETF. But no, they've outdone themselves. This is the very first weekly ETF dividend payer. So let's dig into it. But before we do, if you find value at any point in this video, please ring that bell. It's free for you. It means the world for me. And now on with the show. And from our fine friends at Kiplinger, SoFi has the new weekly ETF ticker WKLY, which aims to deliver income at an even more dizzying pace as it is the first equity ETF to promise weekly dividends. In October 2020, they had launched the SoFi Income ETF, TGIF, which was a fixed income fund holding both investment grade and junk bonds, but this is the first equity ETF to do so, and it pledges to pay out income to shareholders each and every Thursday. They will pay you each and every Thursday unless that is a holiday here in the United States. Then they will pick a day earlier in the week to pay you. So how is that sausage made? Let's take a peek. Weekly will track the SoFi Sustainable Dividend Index, which the company says, quote, is made up of large and mid-cap companies in both the US and developed international markets. And some of the criteria they're going to use are each holding must have paid regular dividends over the prior 12 months and be forecasted to pay dividends over the next 12 months as well. Companies must also have an earnings payout ratio between 0 and 100%. As a dividend growth investor, I would really like to see that payout ratio closer to 70%, as something in the high 90s is a major red flag to me and would indicate that a dividend cut is likely to be coming. A company's debt to equity ratio has to be outside the top 10% of its sector's companies in the quote GBS universe, which is a field consisting of the largest 85% of stocks by market cap in developed markets. And they can only be included if their dividend yield over the past 12 months is more than 1.2 times the weighted average dividend yield of the GBS universe. I like that they have some filters, some criteria in there, that they're not just going to go willy-nilly picking all companies at random because they pay a dividend. But how many companies do they have? I'm going to tell you at the end, their top 25. Right now, they have nearly 300, 296 to be exact, and their geographic bent, it does say, is what is worth noting. I really like the international exposure, as you're going to see that they have. As a dividend growth investor, I'm too focused in the United States, and I would really like to expand my footprint out into the world. Todd Rosenbluth, head of mutual fund research at CFRA, says it's a rare global dividend fund with likely half of the assets from non-US companies, and they have a target fund yield of roughly 3 to 4%. Weekly's expense ratio will be at 0.49%, a little on the high end, which is roughly twice as high as the average 0.24% charged by the 10 largest dividend-focused ETFs. And this is where I've always had an issue, is the expense ratio, because I could pick a lot of companies that are expected to perform better than average, just buy those, hold those, create my own ETF and not have to pay an expense ratio. But if you are the average hands-off investor, then something like this is fantastic. There is nothing wrong with it whatsoever. Anthony Noto, the CEO of SoFi, notes that both Weekly and TGIF are nods to the old investing adage, pay yourself first. Just like with their other ETF, TGIF, they have maintained a 5-cent weekly payout since their inception, regardless of how much or little its holdings actually pay out on a week-to-week basis. SoFi analyzes their holdings and predict a certain level of dividend payment that believes it can reasonably pay out throughout the year. And if their holdings should pay a little more, they can always top up the final year payment, or they can distribute a special dividend. They intend for all distributions to be paid out in cash, not capital gains, in order to avoid less favorable taxation. And Kiplinger leaves us with this quote that, however, although the fund intends to maintain a consistent weekly income distribution, depending on the timing of the receipt and payment of dividends from the fund's underlying holdings, the amount of the fund's weekly income distribution may fluctuate. What? It may fluctuate. So I went to SoFi's website and looked under the hood at their prospectus, and I found a few interesting things that I would like to bring to your attention. A higher portfolio turnover rate may indicate higher transaction costs and may result in higher taxes when shares are held in a taxable account. So right away, they're giving you a little bit of a tip that it would be much better to hold these shares of Weekly in a tax advantage. Oh my God, tax advantage. That it would be better to hold these in a tax advantage account like a Roth or a self-directed IRA. Expanding further on the criteria, companies must have a minimum free float market capitalization of $1 billion or $750 million for companies already included in the index. And under normal circumstances, the fund will invest at least 80% of its net assets plus any borrowing made for investment purposes in dividend-paying securities. I find it really curious that a weekly dividend ETF is putting only 80% of their assets in dividend-paying companies. I'd love to know where the other 20% go. I can only speculate. Maybe they're going to plan on trying to buy growth companies or sell covered calls on growth companies. Fund distributions are generally taxable as ordinary income, qualified dividend income, or capital gains unless an investment is in an individual retirement account or other tax-advantaged account. Again, it'll benefit you if you have the option to hold these shares in a tax-advantaged account. The fund intends to qualify each year for treatment as a regulated investment company or a RIC. However, the fund's failure to qualify as a RIC or to meet minimum distribution requirements would result, if certain relief provisions were not available, in fund-level taxation and, consequently, a reduction in income available for distribution to shareholders. Much like a REIT has to pay out 90% of their earnings as a dividend to maintain that special tax status, so too will this fund have to meet minimum distribution requirements. And if they can't do that, that could affect your distributions down the line. And for my friends overseas, I love you all. If you are neither a resident nor a citizen of the United States, or if you are a foreign entity, distributions other than capital gain dividends paid to you by the fund will generally be subject to a U.S. withholding tax at the rate of 30% unless a lower treaty rate applies. The fund may, under certain circumstances, report all or a portion of a dividend as an interest-related dividend or a short-term capital gain dividend, which would generally be exempt from this 30% U.S. withholding tax, provided certain other requirements are met. I'd again like a little bit more clarity, but it sounds like where they can, they're going to try and help all of you that are in foreign lands out by getting you a better tax treatment. I looked inside their prospectus and I took a peek at their top 25 holdings as of right now. So right away, 10% of every dollar that goes in is going to go to number 1, JP Morgan, number 2, Nestle, and number 3, Procter & Gamble. Number 4, Bank of America. Number 5, Roche Holdings. Number 6, VZ Verizon. Number 7, Intel. Novartis. Coca-Cola is very interesting that they have Coca-Cola in the top 25, but not a company like Johnson & Johnson or AT&T. Cisco Systems, one of my favorite. Toyota, Costco, Texas Instruments, Honeywell, Unilever, Citigroup, Siemens AG, NextEra Energy. Then we hit some Canadians, Royal Bank of Canada, Toronto Dominion Bank, Morgan Stanley, 3M, BHP Group, which is a minerals company, Resources, Sanofi, and wrapping up 25 at 0.97% is CVS. I think this is fantastic for somebody that's a hands-off investor. And because this is so new and it's such a novel concept, I may just add half a dozen shares or so inside of our brand new Roth IRA so I can play along and track this for a year just to see what happens and see how I like it. Take it out for a drive. I'm not an ETF investor because personally I would rather focus on companies that are likely to be better than average. And when you buy an ETF, it's the equivalent of buying every company in your town, the good, the bad, and the ugly. Let me know what you think of the weekly ETF by SoFi. Do you plan on investing in this? let us know in the comments below, because you know where the comments go. Have you seen my video on Starbucks yet? If not, check it out here. Follow me on Twitter at RustyRam78, and I will talk to you in the next video.